Today we have
Sweet.
Zach from Gia DeFi,
Hello,
and
hello.
we're really excited about this episode. So, Zach, how did you get into crypto, and what is Gia?
Oh, wow. Jumping right into it. Not even
Yeah.
wasting time with the small talk. Yeah, thanks for having me, Blue Jay. Love your project. Really love your team. Guess what? What got me into crypto? Honestly, I guess maybe I'll just start with like my life story, which is that most of my career has been focused on expanding financial access in emerging markets. And that began in a very non-sexy, non-tech, non-crypto way. I think of the waves of microfinance, just like we have Web 1, Web 2, Web 3. I think there's like microfinance 1.0, microfinance 2.0, and microfinance 3.0, which is what we're doing at GIA. And in short, what that story is, so I'm from the States, I'm from Philadelphia, but I've always just loved traveling. And so I started my career actually as an English teacher. I taught English in India and Brazil and Ethiopia. I think just because I didn't have any skills when I graduated college, and it was a good way for me to get to live in other places and learn about their communities. And while I was doing that, I would spend a ton of time hanging out with street vendors because I just love eating street food, and so hanging out with folks selling samosas in India or whatever else on the roadside. And in hanging out with them, we get to see a lot of their challenges up front. And a really big challenge has always been access to finance. So when I finally stopped teaching and started like a real office job, which was as a management consultant, I ended up working primarily on financial inclusion projects because I thought that was something that was really interesting to me. And what I should have saw, if you ask the typical bank, why don't you give a loan to that guy selling chai or samosas on the street? They'd say there's really two main problems. The first is I don't really have any data to underwrite them. How do I know how many cups of chai or samosas they sell every day? How do I have any data to prove that they're going to repay me? And two, like the size of the loan they need, it's just not worth my time. If say they only need $100 of working capital to buy their milk and sugar, it costs me more than $100 just to serve that customer. So the first attempt to solve this problem, what I'd call microfinance 1.0, was the model that Muhammad Yunus and the Grameen Bank made famous. Was these group lending models where you'd put people together in a group and they underwrite each other. So it solves the data problem because even if I don't know how creditworthy Sherry is or how creditworthy Kamala is, I they are in a group together, and so like they at the end of the day, Sherry's 10 friends are on the hook for her. So I don't really need that much data about her. The second point is that yeah, maybe Sherry only needs a $100 loan, but 10 of her friends together, they need a $1,000 loan. So that makes it more efficient to serve them. And so I worked on a lot of those type of projects across Africa and Asia as a management consultant. I guess my first gig was got shipped off to South Sudan shortly after they got independence, and I was working on some really interesting agriculture microfinance projects. And I saw that this was really promising, right? Because there were people who were selling basic agriculture inputs who before couldn't get financing to do that in their communities. And that this model was just really not scalable. In order for every new borrower or person they wanted to reach, they'd have to hire more loan agents to go reach them in person. And plus the whole model of just like having to ask all your friends for permission to get a loan, it just is not very modern. And so I should have had this hunch that technology could let us do this better. And that's what led me to what I call microfinance 2.0, which is the fintech lending boom. And that's where I spent most of the last decade of my career, was working on how can we use technology to solve those problems, to underwrite people better and to serve them with good financing options. And so the company where I worked at, we would use people's mobile phone data, which is a really innovative approach, I think, because it says, yeah, even if we don't, this person doesn't have a bank account or a credit score, we can just look at their phone and see, oh, this person is going to be creditworthy and make a loan to them. It also didn't matter that they only needed a loan of $10 or $20 because we're just sending it over mobile money to their phone. And so this is the kind of stuff I was working on, not particularly sexy crypto stuff, but what got me super excited about crypto was over the last several years, as I was reading more and more about the idea of decentralized and distributed ownership. And the reason that was exciting to me, coming from the background that I did working in microfinance, was I thought it really appealed to the basic mental models and organizational principles of how people in emerging markets often organize themselves financially. So in communities where people haven't been served by banks, and even after they are served by, say, microfinance institution or fintechs, they often will, the way they serve themselves for their savings and credit needs is they form these small informal savings and credit groups. And they have different names in different countries. In Kenya, where I'm talking to you from right now, they're called chamas, or sometimes called SACCOs, stands for like a savings and credit cooperative. In the Philippines, where maybe some folks are calling in from, they're called paluagans. In Mexico, they're called tandas. They have different names in different places. But the general idea is people deposit their money and have a shared claim on this like common liquidity pool, as we'd call it in like crypto terms. And I thought one thing that always was really interesting to me was that I remember meeting some borrowers when I was working at this fintech company who said to me, with our SACCO, with our local group, after we repay, we like to put our money in and we get shares. And we really love you guys. We've been taking loans from you and we trust you. So we'd like to have shares of your company. And for a Web 2 company, it's a really tough thing to do. Usually it's like a company that's based in the US, and maybe what would you do? Have a global board resolution to issue some fractional shares down to someone in Kenya. And even then, you have someone like ride up to their store and give them like a piece of paper, like what do they do with that paper? But the idea that you could represent ownership in an enterprise in this more liquid way through a token felt really interesting. And so I remember getting really excited when I was starting to read about these sort of decentralized versions of Spotify, right? Like, why should Spotify get all the value instead of the musicians, right? Maybe you can bootstrap a network with tokens, or the way they're doing it, that Helium's doing it with this decentralized Wi-Fi network. And I thought, this makes sense for microfinance. Why don't we have a decentralized microfinance bank? So that was the first thing that got me personally really into crypto. And then I think, like a lot of people here, probably once you start learning more about it, you find there's all sorts of interesting use cases and applications. And that's what led me to join it.
Thank you, Zach, for going through all of that, like the Web 1, Web 2, and now Web 3, and this whole decentralized mobile bank idea. And so I was wondering, you started to get into it a little bit, but what were you doing before crypto? And how does those experiences inform your foray into crypto and Gia?
Yeah, not to bore folks with repeating my biography, but I think, so my journey is roughly English teacher to dude working on traditional microfinance projects as a management consultant to dude working at a fintech lending company across markets. I think that basically my premise, my approach to building in Web3 is that while there are certainly some nuances and interesting things to think about as maybe as a product manager designing, or as maybe like a token economy designer, or someone having to think about how a network or community is going to play out in the world of crypto, ultimately I think the basic principles do not differ that much. Like I believe that the basic rules of economics still apply in crypto. You need a good sound business to work without a token before you throw a token on it. You need a product that serves some value to people in the real world and in their lives. And so I find myself, as my team and I are building Gia, we're relying on a lot of the great product design principles that I learned at my last fintech company. Really try to put yourself in the shoes of your customers. I think what's a little different is I don't really think of Gia customers as customers or users. I think of them as members of a community, but it's still the same idea. It's think through what's going on in this member's life and where can we fit in and provide some value. And let's not make any assumptions that what we are going to do provides value, or let's not make any assumptions that our solution that we think of at the first go is the right one. Let's test and iterate on it. So a lot of that sort of like flows through my work in crypto. And maybe it's controversial, but I don't think things are all that different working in crypto than in general fintech.
Sorry, I'm just going to quickly jump in. Zach, I really like this sort of combination of the origin story and what you're doing now. And particularly what you described feeling very much like a bottom-up approach to finance, to DeFi. And I just wonder, is that something you're still trying to achieve as you move forwards? And how difficult is it to incorporate understanding what people need as you start moving forward with GIA?
Yeah, great question, Jeff. I still think we're very much, I guess you can call it like bottoms up or grassroots, or just the point is like it's member needs led. So literally what we've like before we've done anything of thinking about, oh, which chain are we building on or what are the tokenomics? Like all we're doing is just spending time with, I mean, our first lending programs here in Kenya are with medical clinics. So we spend a bunch of time with medical clinic owners and understanding where are their pain points in running their business. Some of them are liquidity pain points. Some of them are logistical pain points that maybe GIA isn't set up to serve. And that's okay, but let's at least have that context. And then let's design our products based on those needs versus, I don't know, coming in and saying, here's this really cool theoretical idea of how a networking community could work. And then we built this technology. Now, like we're in search of a use case. Let's go find someone who needs it. So we definitely keep that bottoms up ethos, I think.
That's really cool. Sorry to jump in with a curveball there. It just sounded really, I think it's something that blockchain, crypto, Web3, whatever we want to call it, is ideally positioned to approach in that direction. So I just wondered if you were still pushing that. Sorry about that, Ara. Back to you.
Thanks for the question, Jeff. So we were wondering, like, why do we need crypto to solve this problem? What's the difference between a fintech firm running on TradFi rails versus the DeFi protocol, like for solving this credit gap problem?
Yeah, that is a great question. And I think anyone who is like interested in building any crypto solution, I think should ask that question really hard. And even once you decide, oh, maybe there's some application of crypto here or blockchain here, do I need to launch a token? Because I think there's, especially in these hype cycles, there's a lot of pressure probably that people might feel either from their investors or just from the social pressure of their friends or of crypto Twitter or whatever to launch a token, when often that won't help. I think in our case, what feels really important is that we're able to have a true network that is really owned by these different stakeholders in the ecosystem. It's owned by the borrowers that are getting rewards. I guess I realized I never even really described how GIA works. I'm sorry, I sort of left it at Microfinance 3.0. So just real quick context to describe what GIA does in the shortest, simple way. It's like we have a borrower, a real small business in Kenya, say, like I just mentioned, like medical clinics, or it could be someone just selling fruits and vegetables, whatever. They just have a small business. They have a need for financing. They don't have, just to be clear, I don't think in their minds they have a need for crypto or governance or anything like that. They just have a need for financing. GIA comes in and provides that financing either in the form of a cash loan, which would be in like their local fiat currency in shillings, for example, since that's where a firm principle I believe in is like meeting users where they are. I think that seems obvious, but it's a controversial point. I think there are a lot of people who actually would say, no, you build like products for like the Web3 natives and let the rest of the world catch up. And I think that there is like a real space for that. And there are really cool projects doing that. But I also think crypto will remain the playground of a relatively small group of like tech nerds, finance whizzes, people looking to make money on speculative assets, but not really reach the mainstream who I think can really benefit from it unless we go and meet them where they are. And an analogy is mobile wallets, mobile financial service technology was around for a solid decade before anyone really started using them in a lot of countries. And that's because there wasn't really a reason for someone to use mobile payments until a lot of like the mobile lenders, like the company where I used to work, came in, because they like what people needed was not like a way to pay with their phones. They needed liquidity. And when they realized they could get it by being on a mobile financial services app, then they went there. And I think in the same way, we meet customers with a loan where they are. Back to how it works. When they repay, they are rewarded with a GIA rewards token. And a certain portion of GIA rewards tokens equals like a claim for them to get a GIA governance token. what that effectively does is it's like rewarding them with ownership of the network, which sort of replicates the model I mentioned earlier with their SACOs or their CHAMAs or their local savings groups. And at first, I think we actually don't expect any of our borrowers really to understand that's a liquid crypto asset at first. It's really fine if they just think, oh, this is a loyalty point. And I'm familiar with loyalty points because my telco or there's a lot of existing loyalty programs out there, and people understand, oh, if you spend a certain number of dollars, you get some points back. And in the same way, I think a lot of our borrowers understand these GIA tokens almost just as GIA points, and a certain number of points unlocks lower interest rates or higher credit limits or longer or more flexible terms for repayment. And so I think that helps establish the token as something that has a real use case in their life versus just if they held onto it as like a speculative asset. But over time, it does accrue in value. And ultimately, what we're going to do is what's really cool that I've always loved about this space and about all of the apps being built on top of Ethereum and on the blockchain is this idea of programmable money, and that you can program these different use cases into the token. And going back to this idea of sort of meeting customers where they are and providing something that meets their needs, what we're building into the tokens is almost like digital replicas of what they do offline that just tries to make it marginally better for them to do it online and provide them with more value. So like one example of that, in people's local groups, the savings and credit groups I've been talking about, all of those loans are collateralized. If you want to say, I want to take a loan, and like Ara's in my group, I'll ask Ara, like, hey, I need to borrow 50,000 shillings. Can you put up 50,000 shillings of collateral for me? And you'll do it because you're a good friend. And then I'll repay. And then you'll get your 50,000 shillings back. But you don't get like a thank you or any reward. You get a thank you from me, but you don't like really get anything, even though you've created value for that savings group, right? Because you've enabled me to pay interest, and which provides value to everyone. And so what we'll do with the GIA token is if you stake your GIA token as collateral for another borrower, when they repay, you get GIA token rewards. And this is all like simple stuff. It's not like you don't need like crazy algorithms to figure out how it works, but it maps what people are already doing. So why do we need crypto? For me, I think the most efficient way to run one of these distributed ownership networks is through the blockchain. So that's the primary reason for us using the blockchain. A second reason, of course, is it's a great source of liquidity. And what we've seen, I think, in these recent cycle is there's a lot of liquidity locked up in crypto that is probably interested in being deployed for some real world use cases, which are insulated from the volatility of crypto assets, and even insulated from the volatility of, say, the S&P 500 or other public equities markets. And there's nothing quite as like real and uncorrelated in some ways. It's just like someone selling fruits on the roadside in Kenya. That's a business that will always be there, that people are buying, and there's cash coming in and out every day. And we provide this way for crypto holders to get a return. The way there's really great other, obviously more prominent real world asset protocols like Goldfinch and Maple and Centrifuge. And we can maybe get into later why we're a little bit different. But that, in short, is why we use crypto. I think what's really fun to think about in the future, though, is how by having this distributed ownership and distributed governed community, you can think about this like really going in different directions based on how the members want to take it, whether that means like launching new products for their needs, and I think a really exciting thing I think about is building up people's on-chain credit records so that today, this medical clinic we're serving has no shot of getting a loan from Aave or Compound, right? They have no crypto assets. They can't get a collateralized crypto loan, and they can't even get it from some of the like new protocols which do less like semi-collateralized crypto loans, so they have no on-chain record. But they can build that up with GIA, and they can build up like their crypto education and begin to build up some crypto assets, and that sort of unlocks a new future financial world for them. So I'll pause there.
Love it. Using crypto lets you like basically take this wherever they want it to go, on-chain credit. That's awesome. And I also really love that you mentioned the thing about how you really meet people where they are, and you don't build for just the crypto native folks, you're building for everyone. That's awesome.
Yeah, I think we're probably like maybe on the opposite end of the spectrum, right? There's some protocols which maybe only build for the crypto native folks, and we're more on the, at least when we're building the borrower facing piece of it, it's really for just everyday people.
Zach, on the reputation credit scoring side, am I right in thinking that's taken care of by the GIA points and the GIA token, or do you have any plans to build that out with more of a formal reputation system, or would it remain sort of a function of the token?
Yeah, no, that's a great question. So our vision, the idea is that people will be building their on-chain reputation through their, say, accumulation of GEO tokens, and then just, and even forget the token, just like their accumulation of an on-chain credit record by taking loans and repaying with us. The reality is, in the beginning, the way the underwriting has to be done is very real world and very, unfortunately, off chain, right? Because that's where their data exists. And at the end of the day, these are real world businesses with real world risk. And so the way we serve customers is we actually partner with, there's lots of like local networks of businesses who maybe they serve these businesses in some way, and they have a need, those businesses have a need for financing, and the aggregator network doesn't want to provide that on their balance sheet. So an example, I'll just tell you, the first pilot I mentioned, this medical clinic program, is with this company called Ilara Health. They're really cool. You guys should look it up. If I was better at tweeting and talking, I would tweet them. But it's Ilara Health, and they have this network of medical clinics here in Kenya, about 1,200 of them or so. And their mission is expanding access to quality healthcare in Africa. And so what they do with these clinics is they provide low-cost diagnostic devices. They also provide medicines to these clinics, right? They have the purchasing power of a big central entity, and they get to sell them to the clinics at a slight discount than what the clinics might get on their own if they were just buying themselves. And that's really often how they make their money, right? Is in the margins of the wholesale to like semi-wholesale medicine sales. Now, all of their, like pretty much all of the clinics ask, hey, can I have financing for this? Can I pay later? Can I get these on credit? And that makes sense, right? Because they are getting this shipment of antibiotics on January 1st, but the patients don't come in to use the antibiotics until January 10th. And maybe those patients don't end up even like paying until January 20th. So they've got like a working capital problem. And Ilara Health doesn't want to have that on their balance sheet. What their balance sheet is made for is signing up new clinics and serving them with quality medicines, right? So we step in and we're the financing partner. And that's where we begin to build our relationships. And our partners are other examples like that. There's aggregators there's networks who serve small informal retailers who just sell consumer goods like shampoo or cooking oil in their neighborhoods. There's e-commerce merchants who have a need for working capital. And so what we do is we partner with these companies. The companies, with the customer's consent, agree to share data on those customers that we're able to use to underwrite these borrowers. And that's like an off-chain thing today. What our goal is ultimately to bring more and more of that data and more of the actual scoring on-chain, so it's as transparent and can really move from what's today a bit of a pilot centralized underwriting model to something that's more decentralized, or at least more transparent on chain. Obviously, you can't put everyone's like personal identifying information and like the details of every medicine being sold in their community on chain, but we can get closer to putting things that can be, like you said, Jeff, like that proof of reputation, so that the idea is not, one thing I love that's so different about Web3 versus Web 2 is the goal is not to capture a customer for GIA. It's not GIA's here and that's the only place you should ever get a loan from. It's like GIA is a protocol to open up member access to financial freedom. And if you can build up a proof of reputation to go get capital that's like a bigger amount or a more flexible term or a lower price from some other protocol, like all the power to you. And I think Web3 is this cool, in some ways it's like capitalism on steroids that I think is not great, but sometimes it is really cool in that it's just like competition works in almost this like collaborative way. Well, the GIA protocol will have to keep getting better if other protocols are serving members better.
Great answer, Zach. I really enjoyed that. And I think it's really cool because I think this is what we do to solve the problem for people who are underbanked and underserved by what they have. We give them the tools to build the reputation and the creditworthiness and the presence that they need. And that benefits everybody in the system, I think. And I think you're right. While it's competitive, the collaborative nature of that is what makes it quite exciting as well.
Indeed. Are you from the Blue Jay team, Jeff? I don't think I've ever met you, but
I am, sorry. I've been lurking around, and Ara just asked me to jump on as well so I could help host out on here.
Nice. Thanks. Nice to meet you, Jeff.
Thanks, Zach, for sharing. So you shared about the clinic as your customer, and we were also wondering if you were a typical retail investor, how would they interact with GS protocol?
Yeah, so today we don't have a permissionless pool up yet. So today, unfortunately, the only way for retail investors to interact is it's quite old school. It's just to write to invest@gia.xyz, and then we can have a conversation, because we do have a permissioned liquidity pool that we're opening up, where it's a more human Web 2 experience of the GIA team talks to you, understands your risk tolerance and risk profile, and then we can see how we can deploy your liquidity and what kind of return we can provide to you. And that's how we'll probably be operating for the next let's call it like 6 to 12 months, while we get the workings of the protocol going. We feel it's very important to us that we are responsible with anyone's money, and that we don't want to be taking people's money that we're not ready to deploy and get a strong return on. Once we've gotten those mechanisms worked out, we will launch a liquidity pool on chain. It's very similar to how you can deploy your stablecoin on Goldfinch or Maple or Centrifuge or other DeFi protocols. And so we're really excited for that. And we think folks like Blue Jay will be really great partners in making that happen, right? Because there's going to be a ton of interesting stuff in the background, which is not necessarily new to the world of financial instruments, right? But like the need to hedge FX risk. How do you do that on chain when there's no liquidity around like a Filipino peso stablecoin? And that's why I think one of the reasons why Blue Jay exists and why we're pumped about you guys.
Awesome. Thank you, everyone, for tuning in. Don't forget to claim your OAT, your badge of attendance for this Twitter Spaces. So we started talking more about Goldfinch and Maple. How does GIA compare with these other real-world asset lending protocols?
Yeah, so I think the biggest difference, I remember when I first read about Goldfinch, I was like, yes, I love this. This makes so much sense. And actually, some of the early members of that team are people who I had interacted with in the world of fintech credit in emerging markets, because some of them have real experience there. I think what they're doing, which makes sense, is a really scalable model, is they're like bringing all wholesale debt on chain, right? So for them, they're not ultimately changing the lender-borrower relationship on the ground level here in Nairobi or in Manila, right? Like, it's at the end of the day, the borrower unit from the Goldfinch protocol is a fintech lender, like the company where I used to work, or like the many fintech lenders who are out there. So they get debt from Goldfinch, and then they deploy that the way they've been deploying other non-crypto debt to their borrowers on the ground. What's really drawn me to this space, as I mentioned earlier, was the idea of a more equitable distribution of value. And what I think I grew a little bit frustrated with in the world of Web 2 fintech lending is, I think what I saw sometimes is, at the end of the day, how does a lender make money? They make money because they give out some money, and then their borrower pays back more than they took. And why are they able to do that? Because they have some economic activity they've generated. Like they're buying mangoes wholesale. They sell each mango individually. They're making a profit. What I've seen in a lot of Web 2 fintech lending models is more of that value is captured by the lender than by the mango seller at the end of the day, who's already in a pretty disadvantaged position. And taking a step back from fintech lending, but just thinking about the way the world works in general, we've seen in this sort of dark late stage capitalism, this increasingly exponential world of income inequality, which I think is in a lot of ways expedited by some of these tech platforms, which have done a lot of good for the world, but they've also made the privileged, wealthy with resources all the more able to claim more value than the rest of the people in the world. And that's really frustrating to see. And so what led us to start GIA was this idea that we can provide more of that value to, and not just the value in terms of, oh, like here's like a $10 rebate, but in terms of like long-term upside and actually owning the protocol, we can do that through crypto. And so what we're fundamentally different than Goldfinch is not really changing that on the ground. And they still play a really important role because there are really great Web2 fintech lending companies out there that need liquidity. The way I think of us, like in today's world, the GIA protocol could borrow from the Goldfinch protocol if the cost of capital was right. So that's a comparison there.
Thank you for breaking down the differences between you guys and Goldfinch and Maple. We love that it's a more equitable distribution of value, and you guys really want this long-term upside for everyone. What are the markets that you're going to be targeting for when you launch, and why those markets?
Yeah, so in the long run, we really think this is the solution, really, honestly, in the long run, longest run for the whole world, in the sort of 5-year horizon for any emerging market where there's a real credit gap for small businesses. But we are beginning with 2 markets in particular, Kenya and the Philippines, that one frank and honest reason is, like anyone who's on here who's started a company before, the odds for a startup are already so high, it really helps to just start with what you know. And I've spent about a decade of my life working in microfinance in Kenya and the Philippines. And so it's just so much easier when you already know these markets. You know the regulators, the potential partners, right? Like the folks at Lara Health who run this medical clinic network. It's not like I had to show up in Nairobi and be like, whoa, where am I? Like, how do I even call a cab here? Like, I've spent a lot of time here, so I know the different players to partner with. So beyond the GIA team familiarity, there are actual, like, our macro reasons. Some of them just have to do with crypto adoption. Kenya has the highest, by some measures, crypto adoption in Africa. In some ways, that's because Kenya just has super high, it's maybe more advanced than any country in terms of mobile financial services adoption. There's really like a hustler culture here. Everyone has a side hustle and people figure out new technologies and how to make them work for them, which I think is like this like vibrance and entrepreneurial energy that you feel like anytime you hang around in Kenya, whether it's like with entrepreneurs in a market on the street or with like tech entrepreneurs in a co-working space. So high crypto adoption here in Kenya, and very high in the Philippines as well, which of course partly was brought on by the whole play to earn boom, but a lot of that sort of crypto curiosity has stayed. They are also both by, I guess, relatively, from a regulatory perspective, relatively friendlier places to do business as a company like ours. And I think one thing which has nothing really to do with crypto, but is just from a more macro trend perspective, is these are places with a very strong demand for credit, an unmet need for credit, and an increasingly high level of digitization of the economy in general, right? So in Kenya, it's very easy for us to underwrite a business, whether they're selling vegetables or whether they're selling medicines or whatever they're selling, because so much of those transactions happen over mobile money receipts. And that just makes it easier for us to disperse and collect a loan. It makes it easier for to underwrite a borrower. So that's another reason. I guess the final thing to say, of course, is like because we've worked in these markets, we have great team members in both places. And yeah, if you're in either Kenya and the Philippines, give us a shout. We'd love to hang out and have some nyama choma or balut with you and have a nice party.
Can I come to that party? That sounds amazing.
Yeah, anyone's welcome. Yeah.
I really the model there, Zach. And one of the questions I would have on that is, especially bringing in these sort of almost cooperative, you spoke about the model that you looked at fintech and in the past. How difficult, what are the challenges around scaling that upwards when you start doing that across different places? Because you've got to get the assessments done, you've got to bring all those different people together, some of them on a much smaller scale. What are the challenges associated with that?
That is a really great question. So in some ways, I'll start with what's the easier kind of business to scale is like the way Goldfinch is set up is just like a debt protocol, I think is almost like an easier one to scale. It has a less of like a startup problem. In some ways, like the mobile app lending companies where all you have to do is throw an app in the Play Store and then run some like Google or Facebook ads and get people to download. In some ways that scales a little bit better because it's not as partner dependent. For us, what we have to do over the coming years with this sort of B2C, this like channel partner acquisition model is make a lot of those relationships, which in the beginning requires having some folks do business development. It's not too intensive. It's like a repeatable model. And we think it's the one that makes sense to begin with, because frankly, what's really important for us, we really believe in doing business credit as opposed to just general consumer credit, partly because it just leads to more income generation and better outcomes for communities, less people, I think, stuck in debt. It also is really helpful going through these partners because you have a trusted network. You don't have to come and show up in their neighborhood and be like, hey, we're Gia, want a loan from us? And they're like, who the hell are you? But we show up through a partner that they already have an existing relationship. And that partner has data which we can use to underwrite, and we can even fit into their payment flows, right? So with one of the e-commerce partners we partner with, when the merchant who's taken credit from Gia gets a repayment or gets a payment from a customer, that can be directed directly to Gia as opposed to, so there's not the credit risk of, oh, are they going to pay us? It's just you're underwriting on cash flows. So I mentioned the tricky thing about scaling this is requires some business development effort. But what I think is so cool about I've said like a lot of things I think are so cool about Web3, but like another thing that I think is cool is this idea of the protocol composability and the idea that anyone can take it and use it. And so what I'm hoping in the more medium term is that sort of anyone who has a network of small businesses or micro entrepreneurs, or even you can just call them like individuals, a network of people who has a credit need, can tap into the Gia protocol without having to have a business development relationship with the Gia core team and get underwritten and then get access to credit that way. But yeah, it's a great question about scale.
Thank you, Zach. So you started sharing about how you acquire your customers through doing these more BD efforts, and how did you acquire your first customers, like the MSMEs in Kenya and Philippines, other than these e-commerce networks?
Yeah, honestly, it's not as sexy as saying we launched something on chain and then it just went viral. It really was. I'm friends with the guy who founded Alara Health. I'm friends with I'm not naming the other ones because we haven't publicly launched them, but there's some e-commerce companies in Kenya and the Philippines, and I had a relationship with them. A few of the founders were actually angel investors in Gia, which gave us even further strategic alignment. And I think what's interesting, this is like probably not a surprise to anyone who's dialing in from an emerging market, but need for credit is like a super real need. Like basically every business and every business that serves businesses has a need for credit.
I think we just lost Zach a second there, but I'm sure he'll be back on shortly. In some respects, I'm amazed that his connection was as good as it was, but hopefully we'll get Zach back up shortly. I'm going to keep an eye out for him. Just a reminder, listeners, you can collect your OATs for proof of attendance. I don't think they've all been collected yet, but it's probably getting pretty close, so do that. All right, any sign of Zach dialing back in yet? I'm just scrolling around.
Not yet. Let me ping him.
The trials and tribulations of traditional infrastructure, whether it be mobile or otherwise. So hopefully he will be back on shortly. To fill the gap, I'm going to do some shameless plugging for BlueJ here. We got our testnet moved over to Go Early, so do get over to the testnet and check that out. Zach's back. I'm going to stop my plug and bring him on stage, no problem.
Whoops, I'm back. I have no idea where I got lost.
Welcome back.
Sorry, guys.
Welcome back.
At some point, I was like on a riff about how there's such an unmet need for credit that it's not really hard to find partners. And then I was going to give some inspirational speech that, like, if anyone here is listening, thinking, oh, I want to spin up a real world asset protocol to do loans for small businesses in emerging markets, I would like strongly encourage you and not be like, oh no, another competitor. I'd be like, yeah, there is a huge unmet need. So plenty of room.
So you have all these partners and there's all this demand. What is it like to educate the customers on the use cases of crypto for credit? Is it easy? Do they get it immediately? What's that like?
Yeah, so in some ways, it's not difficult at all because I think we're taking a bit of a phased approach. It would be difficult, certainly, because we've tried this in user interviews to just come in and explain, hey, you got a Gia token. This is crypto. Now you can trade it in for Ethereum, and then you can stake your Ethereum here. And that ultimately that's like super duper hard. But if we begin with just meeting people where they are, which I meant is you almost abstract the crypto elements of it from the beginning, and you just get people comfortable with the idea of a loyalty point. Then you build, it's like scaffolding on top of that. And I think that's probably familiar to I imagine most people on the call, it's certainly familiar to me that like my first interaction with crypto was not, it's not like on day one I got on MetaMask and started like making transactions in a non-custodial wallet, right? What I began with is I signed up with my email on Coinbase, and I just used my experience with crypto is much like my experience with trading stocks on Robinhood or on Vanguard or whatever. So in some ways, like Coinbase met me where I was, and then they have all these learn tutorials, and they begin to learn more about it. You get more curious about it. You begin to realize, oh, you can even abstract some of the scarier on-chain stuff through Coinbase, right? Like you can stake your ETH for ETH2 right now on Coinbase without leaving the comfort of your custodial friendly interface. And so in a lot of ways, that's what we're replicating for customers, is just this almost like a phased approach to introducing them to crypto. Now, what does really help is, I think one thing I mentioned is, at least certainly in Kenya and the Philippines, what I've seen is you have these like Gen Z millennial users who are super tech savvy, super quick to understand crypto. I think a lot of them are really attracted, frankly, just like the opportunity of wealth creation and to avoid the devaluation of their local currency. The Kenyan shilling and the Philippine peso, they're not as troubled as like the Argentine peso or the Nigerian naira, but they certainly are devaluing against the dollar. And that's a real challenge. I met one of our pilot borrowers in the Philippines. He's a baker, very simple real world business. He has to import his flour, his cooking oil, and even like his fuel to deliver his baked goods. So all of a sudden, partly because of macro events, like he gets his cooking oil from Ukraine, so that's going to be hard already. But even without that, like the Philippine peso no longer has the purchasing power it did. So all of a sudden he goes from making 1 peso for pandesal he sells. A pandesal is like a delicious little Filipino breakfast bread. To now he's actually like losing a peso for every bread he sells. Like he's losing money just doing his business, simply basically because of Filipino peso devaluation and also like some macro catastrophes. For someone like that, it's really not that hard to educate someone about the opportunity to have more of your money in, say, a US dollar stablecoin, where they are not as vulnerable to their own currency devaluation.
That's awesome. Meeting people where they are. And you like done all these user research and all of these research trips. Can you talk more about them? And what are some of the learnings that you're incorporating into GIA?
Yeah, that's my favorite part of this job. And I think I just feel very fortunate that my job involves me like getting to go to a fish market in Manila or like a bakery. That's like how I like spending my time. A lot of it's just like I love food, but even places that aren't food, it's just like fun to do that. Anyway, what's really fun there is we have a really great product team who's skilled in some of the best sort of like product design methodologies. And so we do like fun card sort exercises to say, okay, so if you could get like these different token rewards, which would you prefer? And let's try to understand like what's the response to this different language around, does ownership resonate or is it more like membership? What works there? Anyway, so that's like in short, like what a lot of the user research that we do, everything from this high level, just walk us through your finances, to much more tactical, respond to this app screen. I think the key learnings we have from our research trips, if I were to summarize like some of the key themes, is customers really want a sense of belonging and community in their financial services. That's probably not that surprising, but I don't know. I think most people probably don't feel that in their financial institution. Maybe some banks do a better job than others, but most, I think, do not have like the feeling of like friendliness and welcomingness, especially in emerging markets where people often feel like intimidated just to walk into a bank branch. And I think it boils down to the fact that, as I mentioned, most people, the way they were living their financial lives was in communal settings already, whether it was in small like rotating savings and credit associations, their chamas, their paluagans, whatever, or like even just informal business communities, right? People feel like, oh, I'm a member of the like rickshaw drivers association of Bangalore or whatever it is, right? And so that insight is really stuck with us, and it helps us think about how we design the GIA token experience, and that it shouldn't just be like this pure economic asset where it's like you get it and then it's okay, immediately how can I liquidate it or what can I do to like have some financial instrumentalization of it, but like how can we have token ownership feel like a real community? How can it be like almost the equivalent of having shares in your local Sacco where like you all have a weekly like dinner and you're hanging out with each other's families or something like that. So that's maybe just one key learning, is just that people want this sense of belonging, which I think is really powerful. I think let's see, what else is another thing. I think one thing I do feel very strongly about is this idea that people who are running their small businesses, and generally they're working like really fucking hard. If you like, I'm not sure if anyone like on the chat is like a baker, for example, but like this guy wakes up at 2 or 3 a.m. every day to get to his bakery, get the oven going. He has to like deliver like all around the neighborhood, and then he's like basically working all day until 9 p.m. just like on his feet, moving constantly. He's like hustling, all just for like relatively like low margins at the end of the day. And I think like when I'm talking about this one baker in particular, his name is Armand. He's in Bulacan, which is like a suburb of Manila. And I think he felt like a little like frustrated that so much of the value that's created by his hard work ends up being captured by other people, whether it's the people like selling him like what he sees as like overpriced cooking oil, or more likely what he sees as like the high-priced money lenders that he relies on to fund his working capital. And so to the extent we can make people feel like, hey, Gia is like your partner and we're here to grow with you, not to take from your growth, I think that's a really important point, and that we want to build that into our product experience, to our messaging, to our token design, to everything.
That's awesome. Thank you for sharing Arwen's story. It's great that you're working to give more ownership back to folks. And since you started in Kenya and the Philippines, how do you think about regulation? Since it would be different for each country.
Yeah.
So is there like a KYC, building these on-chain, off-chain credit scoring for these businesses? How does it all work?
Yeah. So we're beginning in this very like Web 2.5 kind of way, where we want to always be like on the right side of regulation. I don't think there's any like special rewards to people who are like breaking things beyond the bounds of the law, and the law is not hard to comply with. It's not that hard to just do KYC on a customer. You can do that through a mobile app, right? They can upload their ID and share some proof of their valid existence, right? And we do that because well, it's better frankly for credit risk mitigation. It's also required by the law to make sure these governments have KYC and anti-money laundering rules for a reason. So we are sticking on the right side of the regulators for that. What's interesting though is most governments still don't have a really clear stance on how they think of crypto. Some have just stayed quiet. Some, like Nigeria, have taken a much more like all right, like ban stance. But what I think is really cool, like what I'm seeing here in Kenya, is the government in Kenya has always been somewhat like of a frontier pusher when it comes to financial innovation, right? They came up with M-Pesa, which is like the world's most successful mobile money network. And I think the Kenyan government is interested in, hey, crypto, whether we like it or not, crypto is here. So how are we going to make sure it is used for a productive purpose for our population, for financial inclusion, and not for, there's understandably a lot of fear around scams, because frankly in crypto there are a lot of scams. And I think people to some extent do need to be protected from that. But the Kenyan government here the Capital Markets Authority has a regulatory sandbox. There's also a new entity called the Nairobi International Finance Center, which has a regulatory sandbox. And so those are great places to begin exploring new business models that incorporate crypto. So even if today Kenyan banks can't talk directly to the blockchain, I think my hunch is in the coming years, they will find a way to do.
Cool. So since you're like building this like on the right side of regulation and like building in financial frontiers, like how are you thinking of the fiat on and off ramp issues for both markets?
Yeah, so definitely in some ways it's like at its most basic, it's just like a financial rails problem that you'd have in like a Web 2 fintech lending company too. It's just like, how do we get our money to customers in the fastest, cheapest, most efficient way that like meets them where they are? And so what doesn't work today is for us just to say, hey, we sent you money in a crypto wallet we set up, and then leave it to the customer to figure out, okay, what do I do with this? There are fortunately a wide range of like on and off ramp partners that serve both Kenya and the Philippines, and that increasingly serve emerging markets. And a lot of that work is done by, there's like great ecosystem builders. Like we don't have a favorite chain yet, I'd say, but like a really exciting and inspiring ecosystem is Cello, right? They've done all of this work to try to have a strong on and off ramp network basically in every emerging market. And they've really tried to build a mobile first experience so that anyone in any emerging market can begin interacting on chain and not have a hard time going back and forth between fiat and crypto. And I mean, I think that in short, that's what we're doing. We're evaluating a few different providers in both Kenya and the Philippines that will serve our needs. We might end up using more than one just so that you'd have a backup should something go down or in case there's not enough liquidity on the on-off-ramp network. But there's great folks here in, I don't know, like I can shout out a couple of them in Kenya because they're doing great work and you guys should follow them on Twitter. There's one called Kotani Pay, one called Honeycoin, and I think I really like both of the work they do. I think they're both funded by, we have a common investor in Florey Ventures, and I really love both of those teams, so just wanted to give them a shout out.
Thank you so much for sharing your journey with us. It's so amazing to hear how you've built Gia and all these amazing examples. As we wrap up, I wanted to ask, what is your vision for the future of crypto?
Wow, that's a great, simple question that I should have a better prepared answer for. But what I envision is like a world where everyone feels financially free. And I think that's a very vague vision. What does it mean? Is that people feel that they have the financial freedom to pursue their dreams, to feed their families, to not be worried about how they're going to make their next loan repayment and put food on the table for their kids. The existing financial system, it's not all bad. A lot of the financial challenges we have and the reason why we don't have financial freedom is not all the bank's fault. A lot of it's just like the legacy, unfortunately, of like colonialism and like a massive unequal distribution of wealth in the world because a lot of countries were extractive of other countries. It's also somewhat a result of like capitalism unhinged maybe and often like maybe broken capitalism where you have like political insiders are able to corruptly game the system and take more of the money for themselves than for their citizens. But that said, even that aside, like banks, the current financial infrastructure of today is not meeting the needs of people. You still have incredible amounts of citizenries who don't have bank accounts. Often that's not because like people don't know about banks. They choose not to have bank accounts because the bank accounts have minimum balance amounts and they have incredibly high fees and they have products that have really poor user experiences. Now, currently a lot of crypto products do too, so that's something for crypto to work on. But I do think the ability to reduce the cost of payments across borders, the ability of people to be free of the devaluation of their currencies, which just really brings a lot of hardship on people for no fault of their own. I think these are really exciting opportunities for crypto. And what Gia's finds its part in is expanding access to credit so that anyone who has a business dream can make that dream a reality.
Awesome. Thank you so much for sharing that. It's super inspiring. Thank you everyone for tuning in. And thank you, Zach, for being a great guest on our Twitter Spaces.
Yeah, thank you so much for having me, Ara. You asked great questions. Everybody, I see there's like however many, I don't know, 160 people are listening or something. Please follow me and say hi. I think I have an open DM and I'm always down to talk to anybody. So thank you for having me, Blue Jay team.
Awesome. Good night and good morning, everyone, wherever you are. Thank you for tuning in.